Hello, everybody, and welcome to My Print Hash for week 22 of 2026. I'm your host, Cameron Otsuka, alongside, as always, Matt Dines. This week, Matt's going to really walk us through what we're seeing in Europe's energy and sovereign debt kind of dynamics, try to connect that to the offshore dollar system, and then also touch on Japan's importance to that stablecoin versus eurodollar debate. Again, Matt's going to weave that interconnected story, and I think he's got some really interesting insights for everybody this week. So with that said, I think let's start with some stage setting. Matt, you found some interesting comments, and we've heard some things from the EU and ECB side. So I'd like you to kind of start us there. What are you seeing coming from those EU leaders with regards to energy?
So I think, when you're looking at in the big picture, the war going on in Iran, I look to the statements from the key figures, and generally, if you can read between the lines and have a good underpinning of what's happening, they'll tell you who's winning or losing here. And I think in the last week, we got those tells, those quiet parts, being said out loud from Europe's leadership. So we'll start, Cameron, with some statements at conference statements. But number one, Europe is really admitting it's lost this phase of the Iran fight through the energy markets and the commodities channel. Everybody talks about the Strait of Hormuz, the tightness, all of that. But the real signal here is the rhetoric tells you who has access to those global supply chains. And what that means, if you don't have access, if you're getting edged out, and someone else is encroaching in on your former supply lines, what it means is higher energy costs mean weaker access for supply, distribution, and the security of your access to commodity production. So that whole framework, you'll hear me talk about it a lot with the Daniel Yergin, the prize, geopolitics, reflecting access to these resource commodities. That's going on in play here. It's been the kind of backdrop for well over 100 years now, still alive and well today. So you look at these statements from number one was the EU economy commissioner. We don't need to even mention his name. He doesn't show up that often, but the point is he's their economy commissioner. He's a technocrat. He admits that Europeans can expect oil and gas prices to remain above what they were before February 27th. They're going to be elevated, coming out of that for the foreseeable future, right? And they say through 2027 as their crystal ball is what they're communicating for expectations. And then you see Christine Lagarde double stamp that. She said it's probably a fact that price levels will be higher at the end of this crisis. When we see the end of this crisis. So we're literally seeing the end of this crisis for now. I mean, there's further to go. I think it's not officially done until the U.S. Obtains custody and stockpiles of the uranium that's been enriched by the IRGC. We may not get that for a while, but as far as reorganizing the global energy markets, the financial system, all of that, you're seeing right here, Christine Lagarde and this EU economic commissioner, they're telling you it's yeah, we lost. That's the way I see it, but they're saying literally the quiet power, they're wearing it on their sleeve. All right. So this goes to slide 4. Next step. Now that they admit it, higher energy prices for Europe after, the Iran action that's opened up since the end of February, their ECB, their economic projections come out, and they now say they're making it double stamped as well. So they're saying we see lower growth, GDP growth for the entire eurozone is 0.9% real. At that point, you're spitting distance from zero, which is real, the baseline, no real growth. You're less than 1% from that. Yep. And then they also took up their inflation forecast. Now, this is, key distinguishment that I think all of our audience, we want to drill this in. Price inflation measured in the CPI index in the United States or the harmonized EU price index. That's different. Those prices will rise given EU is admitting, hey, we're going to pay higher energy costs after the fact. That is different than monetary inflation, which by definition is expansion in credit, which ultimately comes down to borrowers' willingness to take on new debt, right? And we're going to get into that side of actual monetarist inflation in a second. But right now, the ECB, all of the economic technocrats, they're actually admitting defeat here. Real growth down, price index inflation up. And then last, number 5, you get to the real payload, and this is in the ECB's Financial Stability Review that came out, I want to say May 25th. It was this week. Look at these highlights. The payload is right here. If you assume those things we just talked about, which they've admitted to, or like they've conceded to, the natural output, they recognize there's going to be an abrupt repricing in sovereign bond markets. What does that mean? Yield up. And then the second one, posing risks to euro area financial stability, right? So what they're saying is this sustained energy shock can force that abrupt repricing in sovereign debt yields. That'll carry through in global sovereign bond markets, right? Rates up somewhere means, hey, that gravity is going to pull bond prices down, in the United States, Japan, everywhere. But the deeper point is Europe is stuck paying the price for this conflict that it cannot financially or strategically control. So this is really the exact backdrop. We're locked into a path now that strengthens this long-run case for more centralization of European and ECB monetary control, taking away that power from the national central banks, which we've talked about in prior episodes, the gold that the national central banks have more inventories, reserves of than the ECB. That'll create a back and forth that's going to have to play out over the next 2 to 3 years. But this forces the issue forward. We're headed to this, I don't know, skunkworks project that you keep seeing floated around by ECB officials, that we're moving towards this digital euro. Right? We don't have that much kind of paperwork or documentation on what the thing is. I go deep into the need for it and why it's happening on my interview with Marty Ben on TFTC that aired a couple of weeks ago, if you want to go pull deeper on that thread. But I think right now you're seeing in the real-time headlines today, the U.S. and Iran negotiations have reached a point where we have, it's maybe not won't be the final agreement, but we've got an agreement to get the basics in place. Now, the uranium is the bigger question. This thing's not
That's
over
the thing they care
until
about, yeah.
yeah. But this intro phase, it's locked in, which also increases the probability that these two sides, these businesses, can handshake and work together, and ultimately that leads to that destination on the nuclear front down the road.
Right.
But I think this is the writing is on the wall for the EU, and they were admitting it in public in their statements, economic forecasts, all of that. It's here. So that's that front.
So connect that to me, Matt, to what we're seeing in the US money markets. I know you mentioned something to me earlier before we hopped on about the Memorial Day weekend and all of that. So I'm going to flip us to the next slide here, but maybe what are you seeing, and why specifically highlight the Treasury curve and the Treasury actives curve, and then this 1 month
Okay.
rate?
This is where the rubber meets the road for what we talked about, the difference between CPI inflation, which if eurozone admitting higher energy prices, that means their currency is going to lose, access on the margin to energy commodities and its currency's purchasing power of those commodities and others, metals, agri commodities, all of that on the international market where these things just freely trade and everybody has to compete. That's CPI inflation. Now we talked about real, like monetary inflation, which is expansion of credit. What we saw on Monday in the 4 week T-bill, and then you can go into it on term, SOFR as well in repo markets, short term funding markets. This is your smoking gun that monetary inflation exists right now. So what's happening? That expansion in or that rise in cost inputs for say Europe in particular is showing up in its private sector, reducing its demand for money or new credit creation. All right. So we're going to like walk through how I get there. All right. So we saw on Monday, US markets were closed for most of the day. We had skeleton crews like up until 1 p.m. Eastern time, and then everybody gets to go home and enjoy Memorial Day for afternoon and evening. But we saw something, really kind of incredible in the 4 week Treasury bill. Why is that important? It's your shortest term T-bill IOU that, makes up you think about the US Treasury debt as being the risk-free asset or lowest risk asset in this credit dollar framework that's dominated since, let's say, 1971, but really took off in the 80s. We talk about that all the time. Um, this is your premier deepest liquidity pool collateral asset in that IOU kind of framework. And like it's tip of the spear in the money markets, which is short-term dollar lending. This is where money gets both stored and created. Like it all starts from here. All right. So 1 p.m. New York guys go home. The only trading desks open, right? While your East Coast capital markets, so Toronto, Montreal, they're still in their desks. And then you think, all right, Western Europe, they, will trade. It's evening there, but they do have their A teams still, seated in their seats at the desk because they have to trade with New York as a counterparty. So it's, important hours to be staffed in Western Europe as well this time frame. But what we saw is that 4 week T-bill, it got bid down 80 basis points, right? Which is crazy. So 80 basis points. The policy corridor right now is 3.5 to 3.75. That's where the FOMC left it as of last Fed meeting. They're not going to cut right away. They're just like, let's wait, let's hold steady right here. What these offshore markets showed is, like we talked about it, the energy crisis, all of that, everything out of Hormuz, that has constrained borrower demand for money. It means these banks, these financial institutions, all of that, they don't have any customers who are like, hey, we want to ramp up, we want to borrow more. And then that means the money center banks themselves, where they go to tap the money markets for their marginal dollar, they're also saying, hey guys, we don't need to create any more money here. We don't have any demand. So what do? All right, they're sitting on a large supply of currency, right? The currency isn't destroyed yet. That could come down the road. When I say destroyed, what I mean is those existing, supply of currency, and it's going to be primarily dollars as the biggest pool of in foreign exchange. If this demand now starts going down further, right, or just keeps shrinking, eventually it turns into everybody is paying off their debt, right? There, and that's when I say like currency would be destroyed or
I see.
money would be
It's coming back
destroyed.
out of the
That's
system there. Yeah.
yeah, and that's your flywheel. That's your lack of growth. And like where this leads is like it's a disinflationary impact. Like it's growth reducing, which is exactly what your European officials just said. Like they acknowledged it, they admitted it. So this whole oil squeeze, $200 oil, okay, like we'll see higher prices here in response to that emergency supply shock. But the writing is on the wall. This is actually disinflationary from a credit money standpoint, which is the offshore dollar, eurodollar structure that is in process of being replaced with the next thing.
Right.
So yeah, I just read that move. We saw is excess money. There's greater supply of money, particularly offshore, and we know that like the hours 1 p.m. Eastern and after was when domestic markets were closed, by definition, this impact was offshore activity or offshore influenced activity.
Right.
And you saw it here. It wasn't just the 4-week T-bill. The FOMC, they manage like literally Federal Open Market Committee that they have an open market trading desk. What they did here to reduce the flow of dollar supply offshore coming onshore to keep their policy corridor steady. What they did Monday afternoon was they lowered the rate for SOFR is overnight, but they have longer term. They have a 1 week, 2 week, 1 month. Those were lowered for Monday only. The Monday special, that's the blue box. Those got lowered into the 3.3s to protect that policy corridor from 3.5, 3.75. Basically, allowed New York to maintain that 3.5, 3.75, which is where the U.S. economy wants rates to be. So we've got this dynamic where the domestic U.S. economy still supports that higher rate corridor. If you look at the Atlanta Fed GDP now forecast for Q2, it's at like 4. And that's the real growth number. So U.S. economy is growing at a 4 real
For humming.
on
Yep.
top of this elevated CPI inflation impulse, which was 4. You can already see it rolling over in the March and then April print. We talked about this before. The composition for April, it was the monthly change was down from that March peak, and then it shifted from the actual energy, mark to market pricing of all the way from like oil itself to refined products. You saw owner's equivalent rent just fill in that gap, which is it's a survey number. So it's becoming less and less market pricing to just feels to maintain that higher CPI print. So eventually, as the rest of the world, that deflationary or disinflationary impact, which could potentially turn into deflation, right, which is negative growth in money supply or credit in the private sector. That's really what we're looking at here with this backdrop, in my opinion.
Okay. So then help me tie this then to, you mentioned, I'm going to kind of move us on then to Japan specifically. Beforehand you said Japan has a very important role to play in kind of what's going on between the stablecoin fight versus the eurodollar fight. And when it sounds to me like when you talk about what's going on with Europe and broadly offshore, right? Anything offshore, they're going to be running into some issues. So how does Japan tie into this, and why are they so important in that kind of debate between stablecoins versus what's going on with this offshore dollar?
So the offshore dollar, think about this, it's just a patchwork of connected liabilities. Your dollar is just someone else's liability. There's nothing in between. And it ultimately comes down to your dollar is only as good as your counterparty, right? In that framework, you've got monetary tiers, and this is where Japan's situation comes in as the next battle theater. It's been an open battle theater for ever, but like when I say forever, like post World War II, right? But in terms of like where this battle line is moving, like it used to be Iran. I think the next stage for this process that's working out, the transition from the offshore eurodollar to this stablecoin dollar future. Japan just makes sense as the next key battleground. All right, so we know with the backdrop for Japan, it has to import its energy commodities. It's huge on the international trading market. It's basically $1 trillion of exports, $1 trillion of imports. Like it takes low value added commodities, transforms them inside of its economy into like high value added goods like Toyotas, semiconductors, et cetera. And that's the name of the game for Japan. It's also important, won't go into this here, but it's actually your key entry point for financial integration for the DC and New York kind of power center, integrating into Southeast Asia as that
Right.
Pax Silica growth nexus or like key supply chain nexus for this 21st century future that the American-led order is that's the vision to build that thing out. But what we're seeing in Japan under the old framework in this eurodollar market, this offshore dollar credit market, which still dominates, it's the bigger thing in international trade. That's changing as we speak. We're at that point when, gradually turns into suddenly the Malcolm Gladwell tipping point, type of thing takes effect, and it'll be a big shift when that moment hits, and it's still in front of us, in my opinion. Um, but if you think about Japan's task in front of it, it does have a trade imbalance. It hasn't been able to maintain the same surplus of net exports, right? Where it used to be able to generate dollar flows from exporting more than it imported. That's flipped under like post 2008 largely, and that's a problem for Japan. Why? It has to access international commodities like on this open pool. It has to compete. No one takes yen. Yen is the currency of the realm for those, the four main Japanese islands. I can't go anywhere around the world and they're not going to take Japanese yen. It's just the nature. The world still wants the dollar. And that's not changing in my opinion. So because they can't, these energy, imports, they're invoiced in dollars. The producers want dollars. Japan has to access dollars, and the way they do that, if you're the Tokyo Money Center banks, what you do is your domestic, industry, they measure their balance sheets in Japanese yen, but they have to like to buy the barrels of oil. Their banker has to sell yen, buy offshore dollars in this global FX cartel, which is like the SWIFT network, all of that, the offshore dollar IOUs, the FX currency pairs. You have to tap into that liquidity pool. And then ultimately to settle in dollars, this euro dollar system, they need the highest quality credit, like say it could be Fed reserves, but if they don't have a U.S. banking franchise present, they don't have access to the Fed, and the next best thing you can get is a Treasury or a Treasury bill
Right.
custodied at the FRBNY, but that's your dollar IOU. But to get it, you have to go through two hops. This is Cameron's slide. I went out of order, but it's slide 11, like to visualize this.
Yeah.
The old world, you got to go down. Like if you're Japan getting your oil imports, you got to go through two layers to get to the U.S. Treasury, which is like that's in terms of monetary tiers, that's your pristine dollar claim. Next, you get these offshore dollar IOUs. Last, you get your Japanese yen local currency. So you got to go to as in the yen economy, you got to go through two hops, and then you have to pay a vig to this FX franchise out of London. And we can see in this new world where Japan can't export its way to growth, and backstop its domestic financial system and economy. They need something else. Otherwise, this ends in a hard brick wall. And that's where all the panicans, coming in, the JGB sovereign debt market, yields rising, the yen. You can look at this. I'll backtrace two charts, Cameron. Yen at 160, the soft line in the sand. You're seeing it come under threat again, already like a multi-decade kind of weakness for the yen. We're back at that point where, the moment of crisis, when it comes in the global FX markets and the global dollar, um, Japan is not, on top of its skis. So it needs help here.
Right.
And then second, you're like, why else? Where else do you see this? Next slide, camera, slide 10, yen versus gold, right? This is telling you like, Japan doesn't have natural like gold deposits or resources. It has to go like if its banking system wants to use gold as reserves, as a base money, they don't have it. They've got to go get it as well. So that they can't just print yen on top of the gold. And this is what you see in the gold chart. You see that exponential blow off. We've hit this window. This is the quarterly going back, 20, 30 years. So we can see where we started from with the deflationary bubble collapse in the 90s when the Nikkei just bubble collapsed, and we had this multi-decade recession and depression, call it that. It was a great depression if you were say a 40-year-old Japanese man in 1990, like the last, the 1990 to 2015 period felt like a depression to you. For the most part. But you're seeing this on the quarterly. If we put the chart on gold up there, you're seeing that liquidity taking show up as this commodity tightness situation uh, was like forced to the forefront. U.S. held the control of the escalatorial, pushed it here, and you've seen the Japanese now. They've got to defend their access to the dollar to import these commodities. That's created like a retracement, a consolidation that's just opened up in the second quarter candle for gold on this chart. So you're seeing it in the gold price chart in Japanese yen as well. So back to Cameron's side 11 here. Now the right side of this is where the stablecoin battle becomes front and center. I think this coming, it's not a battle for Japan because there will be no military action here, like Iran or Venezuela. This phase of the battle in Japan is just purely in the capital wars arena, or the capital markets arena, in this bigger picture, geopolitical conflict era that we've entered. I don't know, some point in the last 5 to 10 years, as it's been building up. But so the problem here, we talked about it on the old map. You got to go through, if you're the Japanese domestic financial system, what you want to get down to is your dollar claims, your T-bills at the end of the day, as money to import your barrels of oil. With stablecoins, we now have an infrastructure where the Japanese financial system can access a one-to-one claim on a T-bill, like a T-bill dollar, that they can settle these transactions in, and bypass the VIG of the Belgium-centered SWIFT framework and system, right?
Yeah.
This won't solve the problem overnight, but this is part of the big reshuffle going on in the commodity supply chains themselves. Those access to the production centers like the Persian Gulf that the European leaders are admitting, like, oh, we lost this one on. Like they took the degradation out of that front on the kind of the actual goods side of international trade. Now the complement of that is the financial system, and now Europe's going to get, like, they're going to take the punch in the face on that side as well, right? Like, does this make sense?
Yeah,
So you
yeah, you're
now, for
losing
your
this
Japanese
entire
banks.
business basically.
Yep. Yeah. So Europe lost this franchise as well. They got hit with the double whammy, both the financial settlement as well as the actual supply chains themselves. All right. So this is going to be massive, in my opinion. So you think about the $3 now. You got your onshore dollar. That has an ability with the Fed, the treasuries, the banking system, all of that. Think about these dollar IOUs. They have to maintain 100 cents on the dollar, right? And if you can maintain the purchasing power of your dollar IOU, you have more access or better purchasing power of these energy resources that everybody is competing over. So think about the onshore US dollar. Number one, we produce a lot of oil now, like LNG. We have more LNG, we have more natural gas than we can export. And this is where, like, LNG contracts for the United States are going to be a big growth market. But for Japan, it's not, right? All right. So onshore USD, I don't have any kind of qualms that, that system, that framework can defend its 100 cents on the dollar. And then these stable coins as well, they're backed up by that 45-day or less T-bill. Like, the closest you can get to that Washington, D.C., New York nexus, where, I mean, you can say where the money printer emits, but that's just reality. So now, if you're the Japanese market, you can do one hop, or you can operate on this new rail and pay for your commodities with a dollar outside of the legacy offshore dollar system, but it's going to maintain 100 cents on the dollar as well, right? You'd have to attack the T-bill market, sell off, create a liquidity squeeze, and it's going to be very hard to break, in my opinion. Now it can, and we'll go into the Tether chart in a second. It's still gonna ebb and flow with the overall liquidity needs in this offshore credit dollar kind of capital pool that is still much bigger than the stablecoin pool. But by and large, for the liquidity mechanisms, the creation redemption, you've got a really strong mechanism here as Japan integrates these stable coins into its domestic financial system. This will, all else equal, if you have to try to pay for your barrels of oil imports in IOU euro dollars, maybe those get 98, 97 cents on the dollar, et cetera. And then to bring them back up to par, you've got to pay higher rates. So this is where like increase your yield, your short-term yields. Otherwise, the discount will still persist. And this is where that money market slide we went through is the admission, and the European admission in slide one we went through. They need rates lower because there is no demand for borrowing in the private sector of the economy. So entering this next stage of the conflict, this U.S.-led order, I think, has the wind at their sails, the positioning. They've chosen the time and place of the battle. This is Scott Besson in my mind, who is ultimately the general running the show here. But the military quotes, like, if you can choose the time and the place where the battle it takes place, that's probably half the outcome, right? Come up with a Sun Tzu quote or something like that. It's been there in the art of war. They've known this forever, but we've got that advantage going in. All right, so that's why the stablecoin rails matter. This is going to be huge. It's just starting out. June 1 is when the process begins, and the payment inside of the Japanese financial system can start taking place on these dollar stablecoins. It still means that Japan has to actually keep exporting to get these stablecoins in the first place. But as this trend goes on, this flywheel, like, it's just tightening the noose around the old offshore eurodollar, and the economics, the incentives, like network effects. When you add Japan into this system and they want to see its growth continue, well, Japan coming on board because it's got its own pressing problems, this helps solve their problem. Well, next is like, well, Venezuela, you've got similar problems. Can this help you? Well, we got a second participant. Well, who else? Argentina. All right, come on board. And the network effect just, tilts towards the new paradigm of the monetary transition that Besant is leading us down, and away from that old eurodollar framework, which is no longer long for this world.
Super important to understand.
Yep. All right. So let's just talk about really quickly and then get out of here what we're seeing in terms of liquidity conditions within stablecoin markets themselves.
I was going to
right?
ask, and how does this compare against the Tether piece that you brought up beforehand? So yeah, perfect. Let me pull that slide here. So you have this, and we're breaking the buck on Tether. Matt, explain what you're seeing.
So after the ceasefire announcement between the U.S. and Iran on April 7th, we were already like coming into a point where like the dollar liquidity was on the rise. When I say dollar liquidity, like take all three of these dollars into account: onshore dollar, offshore dollar, and stable coins. You can kind of see it in the charts here. I'm just going to increase my screen so I don't mess this up. So like basically from February 27th up until mid-March, what this price is, it's Tether's exchange rate. So you talk about stable coins, and then they're trading for credit IOU dollars or offshore dollars, euro dollars, right?
Yep.
And what this exchange rate is actually reflecting is, like, you could say two things: demand within this whole crypto ecosystem as like an intake for excess liquidity. This is like, okay, if you see this Tether stablecoin versus offshore dollar exchange rate rising. That's telling you the system is taking in liquidity from monetary creation or just positive liquidity backdrop within this global credit capital market itself. And then on the other side of that, when you see this thing trending down, that's telling you something else is going on. It means liquidity is being pulled out of the stablecoin capital pool and going back in to the money supply of the credit dollar framework. So what's actually happening here? So since really May, it starts right the month of May open. You can see this trend. It's down and to the right on Tether's exchange rate versus dollars. It's broken the buck. This is Bloomberg's pricing services, but if you look at other like CoinMarketCap, the crypto exchanges, you can see it even below. Like I saw like 98 cents on the dollar for these stable coins. And just keep in mind, this existing Tether outstanding is the legacy Tether. It's not the Genius Act, like 45-day and below Tether, which comes into effect. I think it's already out. It's like the USAT. I don't know. It's got a ticker symbol, but you can get the Genius Act version that is reserved 1-to-1 with T-bills, regulatory compliant with Washington, D.C. and New York. And then there's the legacy one, which, is the old thing. But what you see, the liquidity taking from this tether pair trends down. Bloomberg shows it 99 cents on the dollar. What that's reflecting, in my view, so think about what we saw in U.S. money or onshore money markets, the rush into T-bills. What that's saying, the supply of dollars exceeds the demand for dollar borrowing in this whole offshore dollar complex. What Tether is showing is the because it's broken the buck from below, that is the demand for dollars pulling into that eurodollar credit system is dwarfing that. Like there's no excess liquidity creation, which confirms what I said earlier about there's no demand for new borrowing, right? So this is telling you the liquidity trend, it's working against that like it's turned the direction on that impulse we saw from April 7th onwards, where we got that massive torque and risk assets, QQQs, et cetera. Bitcoin had an underwhelming kind of jerk on its chart upwards versus like your AI, semiconductors, memory, equities, all of that we've seen on the chart. Kospi, right? Samsung, SK Hynix, all of that. So what we're seeing in Tether is actually confirming, like moving towards this tightening process that both your European leadership is acknowledging their fate for, like what's coming down the pike, and then Japan as well. You see it in their activities. Cameron, if you go back to slide 8, what have you seen from Japan to prepare for this? They, number one, because they've got to import commodities, they can't. Someone's got to print the dollars and do the new money create, or take on, some borrower has to take on that new money creation. Well, the Takaichi government unveiled it's 19 billion is going to come from extra government borrowing, and they're just going to have to manage the FX, the JGB bond market against that, and then they're also building up reserves, like their dollar reserves, for this defense. So this June 1 stablecoin implementation, like it's not going to solve the thing on a dime. All Japan has to do, and I'd say when I say Japan, the US-led order as well, like this is the key battlefront. If Japan stays upright throughout the summer, that's going to be a meaningful step in this broader US-led monetary transition story. So I'm going to end it here, because if you want to go double click deeper onto that, I just recorded a podcast with Tom Luongo on Tommy's podcast earlier this week, where we talk about this and the big picture. It goes 2.5 hours in. I think it gives a good download to understand everything going on with the stable coins and this transition away from the offshore to the treasury supremacy version of the dollar, what this means, all of that. But we've seen key development this week that to me say the next logical sense for this action to take place, like the next step in this theater, I'm watching Japan closely. So hopefully that gives kind of a framework for people going into it. Like everybody's going to face this pressure as the sovereign debt situation, this abrupt repricing, as the ECB Financial Stability report told us they expect is coming. Every market is going to have to deal with this, and everybody's going to face that problem. But from the U.S. standpoint, if they can get their ally here, who is integrated into their orbit, their vision of what's being built out here, Pax Silica, the stablecoin transition to the dollar, all of that. All we have to do, like if I say we here, because I think of myself, I want American sovereignty to persist through this, but all that perspective has to do to win here just means don't let Japan fall on its face. And I think we got the architecture to get it done. So that's what one of the things I'm watching for this summer. But America 250, the semi quincentennial is starting as well. World Cup. There's going to be a lot of distractions, but inside of the capital market war, this Japan story is the next chapter. I'd say let's keep our eyes on.
Well, with that, thank you as always, Matt, for walking me through that as well as the audience. That's super eye opening, and I think your description of the stable coins, the Japan, and how important that is super helpful for me to kind of create that framework for myself as well. So all I have to say, let's leave it there for the week. Thank you everybody for watching. As always, follow us on Substack, on YouTube, on X. We're at MyPrintHash. Follow Matt at LeveredUSTs, myself at Cameron Otsuka. Hope you all had a good Memorial Day. See you all next week.